Howdy, Jacob here. Today we're looking at company Exponent. It is in the professional services industry, 4 billion market cap on 3.8 billion enterprise value. Founded in 1967. This return on invested capital graph looks absolutely amazing, increasing from 9% in 2001 to over 28% in the most recent year. Growth is very solid from 305 9 years ago to 537. Growth on the earnings per share side, over double, so greater than the revenue growth, which is great. Gross margin, 100%. That's pretty cool. I guess in the professional services industry makes sense. So balance sheet, we see that they have 187 million cash on hand, 291 total liabilities with no short-term or long-term debt. Very safe balance sheet. Cash flow statement. They do not have a lot of capital expenditures, and so basically their cash from operations is very close to their free cash flow figure, and their use of cash is really split between a dividend, which is 1%, and share repurchases. So probably I would say maybe 10% to reinvesting, and then 45 split between share repurchases and dividend payout. So reasonable dividend payout. They're buying back shares as well, so their aggregate. The more shares you buy, you can have. If you don't change the yield at all, it would increase. What am I trying to say? Oh gosh! If you repurchase shares and you have the same payout, so like $1.12 per share, it's going to be less on the aggregate level because there's less shares outstanding. Oof. All right, so let's start making some assumptions here. I could easily see them grow at, say, 5%, and then at the end of 7 years, 16 PE. And then for margins, free cash flow is slightly higher. I like that. Let's do 20, 21. Let's do a bigger range, 19 to 22. And then share change, let's say minus 1% of shares. So they're buying back with 40 million, and that's pretty much in line with their use of it in the past. Dividends, they can afford that, and with them buying back shares, it's going to be cheaper. So let's do dividend per share of, let's just do 5% increase, same with the revenue growth side. And I mean, it just looks expensive, which again makes sense based on the current PE of 40% in the revenue growth and margin expansion, not expanding the discount rate that we're looking for with a 16 PE. So to me, very solid company, but to me, it's just a little bit overpriced at the moment, and I will just be waiting to do further review on it. So thank you and have a great rest of your day.